This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find a download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lack's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed builds across the board, with crude oil posting a 1.2 million barrel build, Cushing, Oklahoma building 854,000 barrels, but the really big builds were on the finished products, with gasoline building 2.1 million barrels and distillates building 3.2 million barrels for a net petroleum build of 6.5 million barrels. U.S. production held unchanged at 13.1 million barrels. The decision by OPEC Plus not to extend cuts beyond the end of calendar year 2024 is being perceived as a strategy change on the part of OPEC Plus to focus on protecting market share rather than protecting price. I think it's a little bit premature to really read that much meaning into it. We don't know. All we know for sure is they didn't decide at this meeting to extend any cuts beyond the end of 2024. We don't really know that there is a change in strategy, so I think it's premature to interpret that way, but that's the way the market has been seeing it. So it's no great surprise that that brought us back down to the low 70s on WTI, and frankly, I've been focused on other markets and not paying a whole lot of attention to crude oil. I don't think there's really an exciting trade in crude oil right now because there's just too much risk of geopolitical upsets that could throw the market in one direction or the other, being unpredictable. And there's plenty of good opportunities in gold and uranium.
It was quite the breakdown in oil, Eric. And the interesting part is that we're now a stone throw away from the 2023 and 24 lows, which were as low as around the $68 range. We're still a few dollars away from anything like that, but certainly technically you can see that we're approaching a key support line. The thing with the breakdown that happened this week was that it really set in motion the continuation of a downtrend below the 50-day, which usually results in a prolonged consolidation. And while assuming that that support holds, we could end up spending the rest of June and early July establishing the bottoms before there is an attempt to bull run on the upside. At any point, there could be a reaction of a couple dollars, but at this stage, I'm considering oil to be range bound and that the next bull setup will be a little bit later in the summer. Let's get to the equity markets and get Nick involved in the conversation. Nick, let's start with that S&P 500. What are the levels you're watching?
Yeah, Patrick. So right now the spot price on SPX is approximately $53.50. We have an implied move for the June 21st monthly OPEX a couple of weeks away of plus minus 100 points. Therefore, the upper implied move is $54.50 and the lower implied move is $52.50. Right now, we have no key resistance because we're at all-time highs, and key support is at $52.50. I'm inclined to think we see a push toward that 5,400 plus area with a topping point around 5,500 in the short term.
Nick, I agree with your upside targets. The 5,400 is obviously the first upside hurdle, and 5,500 to 5,600 are upside measured moves. But I think all of this is going to rely on how NVIDIA trades moving forward. There's a couple of major catalysts, and I suspect that the swing high of the S&P 500 will line up with ultimately where NVIDIA has some sort of a short-term topping formation. Now, right now, there's nothing but pure momentum in NVIDIA on the upside, but there's the catalyst with the stock split position to occur on Monday and a potential big fund rebalancing in the XLK occurring on the 14th of June. It is very likely that next week will play an important role in determining where NVIDIA's upper boundary is going to be. Now, right now, with this kind of momentum, there's no nothing stopping it from still tacking on $100 or even $200 on the upside. But ultimately, when that top comes in on NVIDIA, that will likely line up with where the S&P 500 makes the turn. And so to me, watching how this plays out next week is going to be key. Now, let's move on to the Nasdaq. What are the levels you're watching on the Qs?
Right now, spot price on the Qs is approximately 464, and we have an implied move for the June 21st monthly OPEX of plus minus 12 points. Therefore, we have an upper implied move of 476 and a lower implied move of 452. Right now, we have no key resistance as we are at all-time highs, and key support is just below at 460. As you mentioned with NVIDIA, I do agree with you. I think that the market goes with NVIDIA. If it keeps on pushing, the market will push higher. And likewise, if the NVIDIA starts falling, the market should fall as well. One thing very interesting to note, well, a couple of things anyway. You mentioned XLK rebalancing next week. That's very interesting because if NVIDIA's market cap exceeds that of Apple's on the rebalancing date, what happens is that we see a flip from a current allocation of Apple at 22% and NVIDIA at 5%. To the reverse of that. So not that it really matters so much for XLK, it's not a huge ETF, but what will happen is that the implied volatility of the ETF should increase significantly overall. Otherwise, one thing I want to mention too is that yesterday alone, NVIDIA gained 5%, which added about 150 billion to the market cap. That exceeded the entire valuation of Intel plus 20 billion in a single day. Pretty wild.
All right, Nick, let's just move on to the volatility index. The VIX is back down to the 12 handle. We saw obviously a little bit of a spike during that correction, but we're right back down to the lower boundary. What are the levels you're watching?
So right now with the VIX at nearly 13, we can expect to see intraday top to bottom moves of about 0.75% roughly. As we push those new highs, it's kind of interesting because the VIX is not making new lows. However, if we do push that 5,400, 5,500 level on SPX, I do expect to see a breach below 12 on the VIX. So looking out toward the election, if you're buying insurance, it's pretty cheap right now overall. Not a bad idea to look at some hedges, as I do think we see perhaps a swing high to 5,500 or so on SPX, followed by a decline into the election overall.
So moving on to the US dollar, we continue to see range-bound price action. No sign that the dollar is yet breaking out, but we just had rate cuts from both the Bank of Canada and the ECB, and we're now have the FOMC coming up next Wednesday. And it'll be really interesting to see whether the dollar starts to move after all of these central banks have released their monetary policy statements.
And moving on to page 8, we had that gold futures chart. What are your thoughts here?
Well, just as I predicted last week, gold needed to dip down to test that 50-day moving average before it could correct higher. That's exactly what happened. Now, it's still early to say, but it looks to me like the bottom is probably in for this correction, and Wednesday's action certainly seemed to suggest that we're going to trade nicely higher from here. If we can keep that momentum going and keep this rally going, I think we probably are headed on this leg toward another all-time high.
While gold has certainly stayed above its 50-day moving average and now has worked its way towards 2,400, this is actually a very important line in the sand. If this rally in any way fails below 2,400, there could still be one more leg lower down to 2,250 on golds. It really is important for the bulls to follow through on this north of 2,400 in order to resume the bull trend. So it's a very important moment right here at this exact price level. I wanted to move on to the copper chart. We were talking over the last 2 weeks about a correction in copper after that very steep rise. But now that we've fully tested the 50-day moving average and have approached Fibonacci retracement zones, this is a really interesting level to start seeing whether the buy on dip traders show up. This is a tactical place where the copper bulls will certainly give it a go. And so let's see whether or not the support starts to come in here. We could see a temporary drop as low as 440 on the short term, but generally this level should hold if the bulls are going to keep command of this trend.
And moving on to page 10, we have that uranium chart. Eric, what are your thoughts here?
Well, I think what's happened with uranium in the last few weeks is that many speculators, myself included, got a little bit ahead of ourselves thinking that the rally that we've been predicting was upon us or was starting a couple of weeks ago. In reality, there was a little bit of a move in some of the uranium mining shares, but the spot price of uranium is essentially unchanged. And I think what's happened is the market can't move higher until the underlying spot price of uranium moves higher. Maybe there's a buyer's strike going on or something. The buyers just had their annual convention this week. Let's continue to stay tuned to this market because there are incredibly strong demand characteristics, and the imbalance of supply and demand just couldn't be stronger. So I'm convinced the next major leg for this market will be up. It's a question of time, and I don't think the stocks move until the underlying price of the commodity moves first.
Well, when looking at that Sprott Physical Uranium Trust chart, it obviously had a pretty steep decline in the last week. The interesting part is that really has not been driven by spot prices of uranium declining, but rather the closed-end fund trading at a discount to that net asset value, which I show in this overlaying chart. And what we now have is that the Sprott Physical Uranium Trust is trading at about a 10% discount. We've seen a period where the discount was as much as 15% briefly, but we're now approaching levels that typically the divergence will reconverge. It'll be interesting to see whether this presents at least a tactical short-term opportunity to fade that discount. The last thing I wanted to just touch on was the 10-year Treasury note, the chart on page 11. And what we have is a distinct breakout of the descending trend line that you could draw by just connecting all the highs that were put in this year. As well, the last correction that we had the other week did not follow through to make a lower low, and we're now consolidating at the 50-day moving average. Now, I don't want to get outright bullish 10-year Treasury bonds just yet, but the one thing to watch is going into next week where we have the inflation numbers and the FOMC. If the 10-year note can keep above the 109 level during consolidations and build on this, we may have a turn point here in the bond market. And it's certainly one of the things I'm watching closely here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.